This week on the podcast, there's 5 big business numbers that you need to master in your business. What are they and how can we help you? Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host Claire Hancock is a finance director, chartered accountant and entrepreneur. And every week I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. So the thing about social media posts, Claire, as we've learned this morning, is you're a bit angry at my approach to responding to your posts, aren't you?
Yes, you took charge of my TikTok account for 24 hours, didn't you? And rather than responding with helpful, intuitive comments to people's questions, you decided to play the algorithm and antagonise people.
No. The thing is this is where society today and the world of social media is totally flawed, is that the whole thing just works on the basis of engagement. So the more you can wind people up, the better your post does and the more exposure you get. So you didn't like the fact that my response to everybody's comments on it was, what do you know? Or how long have you been an accountant? Or things like that. Because to be honest with you, then it really winds them up. And then if you then ignore them, they send another and another and another comment. And before you know it, your TikTok this morning, we're an hour in, it's had 1,300 views.
It's a fine balance though, because if you don't get to the point where that post goes viral and we gain a whole fresh new audience, then actually all you've done is make Profit Cash Growth look a little bit unhelpful and probably turn us off to the small audience that we do have on TikTok. So it's a gamble.
I like to play with TikTok because TikTok isn't really our audience, but it's just nice to have a little bit of fun with people.
Don't say that.
I don't know. Well, maybe people can put in their 5-star review they're about to give us whether they actually engage with TikTok or not.
Whether you're a TikTok user or not. But LinkedIn
they're
is
6 and 7 figure businesses, but
LinkedIn's where we focus, and then Twitter, and then the rest sort of all blend into one, don't they?
Anyway, I wanted to talk about something else quickly this morning. Do you remember last week we were talking about the name Xero and how you had to be really careful about your company names? You were at a conference recently. You sent me a mug of a company's name. What was the name of the company, Claire? And say it carefully.
Well, I don't know how you say it, but it was spelled...
No, it's pronounced cunts, isn't it?
It was spelled Kuntze, and somebody posted it on LinkedIn, and I saw a picture of this mug and I thought, why would you put that on the side of a mug? But maybe it wasn't a British company, and therefore sometimes things do get lost in translation.
It does sound quite German, but again... if you're planning on going global, because they were obviously in the UK, do you think calling your company Cunts is a good idea? Really?
No, probably not. But fantastic for marketing, because look, we're talking about it on our podcast.
We are giving them free advertising. Anyway, we've got an interesting one in this week's news story of the week, so let's see what it's all about. So in this week's news story of the week, we're talking about the story Tired Tupperware. What is it, Claire?
Tupperware have gone bust, haven't they?
Tupperware have gone bust after 78 years in business. And do you know my initial reaction to this, which is interesting because when I looked into a bit more detail, I'm totally and utterly wrong. My initial reaction with this is how bad a business owner do you have to be because the brand name Tupperware has been what they call genericized. So people use it for every type of plastic container possible. So how bad does your business have to have been run to have gone bust when everybody calls your product by that name? And it turns out that I was totally wrong. When I did a bit of research into this, apparently when a brand name becomes a product name, genericization as they call it, apparently it's incredibly bad for your brand because of course everybody just assumes your brand, and it's a really bad thing because they're buying into other people's quote unquote Tupperware when it's not actually going into your till, so to speak. So apparently this is bad. They give some examples: Kleenex, Scotch tape, duct tape, Band-Aids, Tupperware, that type of thing. So apparently it's a bad thing to become genericized.
I do agree with you actually, because when we do a bit of research before we do all of these podcasts, that we're talking about facts and we know what to say is correct, and you put Tupperware into Google and the first one that comes up on Google shopping is the genuine Tupperware brand, but it's very difficult to distinguish that Tupperware brand, the official brand, from all of the others that come up. And, you go on Amazon and there are loads and loads of people selling Tupperware. It's not the official Tupperware, but they're using the term and they are selling very, very similar products. But I do agree that I think it's a badly run business, actually, and I think that's why it's gone bust. And I don't think it's anything to do with the name becoming genericized or the flooding of, imitation Tupperware to the market. I think they've got a bad business model that hasn't changed in the past, 78 years they've been running. Their main process of selling to customers was like these Tupperware parties that they used to do. And I can imagine the days before internet shopping and, supermarkets selling product like this, having a Tupperware party was probably the one chance that, women of a certain generation would get to buy Tupperware, and it would be a big thing, but not now. And, really, we've all got a Tupperware drawer. And you get, when you order a takeaway and things like that, you get free Tupperware now. So we're probably not buying very good Tupperware.
Well, you do.
You have a nice lunchbox
Chinese and various things,
that you show to the rest of the world when you go to the office or something. And other than that, everything's just your Chinese takeaway dishes and the things that you get from the supermarket that you rescue.
Yeah. So in the story, they said one of the big things that they believe's killed Tupperware is IKEA.
Yeah, I can imagine that. I mean, I always do a bit of research for the podcast, as I say, and I had a look on the Tupperware website. I Googled a couple of things. I firstly Googled, why is Tupperware different to all of the other cheaper brands on the market? And it took me to a section on the Tupperware website, and even Tupperware couldn't really explain to me why they were different to all these other brands. They were talking about how reusing plastic is good for the environment, and they were encouraging you to use their Tupperware water bottles rather than single-use plastic. And it's like, okay, I get that, but I'm sold to the idea of reusable products. What I'm not sold is why I'm going to Tupperware and paying £30 for like 3 what looks like fairly bog standard Tupperware dishes that I can buy on eBay or Amazon or in IKEA for 5-10 quid. And I think really, when you look at the products, there is a market for premium Tupperware. You look at the likes of Joseph and people like that. And Le Creuset. There's definitely a market for this high-end kitchenware, but I don't think Tupperware are quite cutting through. Their marketing they haven't got the messaging right. Their products don't look premium, but their price is premium.
Do you know what they should have done? And somebody's going to steal this. They should have done a Tupperware that guarantees that it won't taste and smell like the dishwasher after you put it in there.
That's
the biggest problem, isn't
it? But that's why
impregnates into the plastic.
I don't mind reusing the Chinese takeaway dishes, because you put them in the bin when that happens.
Use them once, we use them twice, throw them again.
Well, we use them a few more times than that, but yeah.
Great, so that's Tupperware. They're dead. They're dead to us. Mm-hmm. So, anyway.
I actually found out a mind-boggling fact about Tupperware, which I didn't know, is that in 2003 was when they exited the UK market and stopped doing these Tupperware parties. But for some reason, in 2011, they decided to bring that back to life, and in 2011 they were going to reintroduce these Tupperware parties, but they canned it right at the last minute. So I think the writing's been on the wall for a long time.
It's a bit like the Avon party, the Ann Summers parties. They used to do that, didn't they?
Yeah. The downfall of Tupperware was actually in 2022. If you look back at their annual accounts and their statements and things like that, you can see the problem they had in 2022 was they have significant debt in the business, and they have what's called covenants associated with this debt. And when you have a covenant, it's essentially basically like a binding term and condition, and they're quite common when you get debt from banks or equity investors and things like that, is they will say, okay, we want to put these covenants in place. And they will often say things like, your debt ratio can't be more than X amount, or you can't carry more than X amount of debt on your balance sheet, or your profitability must be over this value. So what they'll do is they will set these financial targets that you must stick within. And basically in 2022, their financial processes, their numbers basically meant that they couldn't meet these covenants anymore. And what happens when that's the case is that essentially the debt can be withdrawn. So in 2022, they kind of said, we can't meet the covenants of our debt agreement, and therefore our whole business is at risk.
So much more going on beyond the background than just the business model itself.
Yeah.
A lot around the accounting.
Yeah.
Interesting. Well, I've got actually a really interesting story as well about Hoover, but I've actually decided to park it and make it into an entire deep dive podcast episode in the future, because it's a fascinating business story that I think we could turn into a lesson for business owners. So watch out for that one. We're going to be talking about lots more genericized brands in the future. Anyway, I'm really looking forward to this week's deep dive, because I love talking about the big numbers in business. Well, let's talk about them. So, Claire, this week we're going back to basics with an accountant/finance director spin on it. And this is the 5 big numbers that you need to master in business. These aren't numbers that people won't have heard of before, but what I want to understand is the difference between my opinion as a business owner and how I look at these numbers, and what your opinion as an FD chartered accountant would be on these numbers. And I think people find different responses to that and find it quite interesting. So obviously fairly straightforward, 5 numbers, but we're going to start with the big one at the top, which is, people call them different terms often, but turnover basically, or sales, as
turnover,
you would call
sales,
it.
revenue, income,
whatever your accounting system calls it. So kind of what I want to go through is kind of what is the number? Why would you track it? What's it best used for? Those type of things. So I'll just share my view of turnover is, I guess the question for you is, how helpful is the number turnover? What should I be looking for from the number? The only view I have on turnover is that it should be moving forward, because if it's not moving forward, it's moving backwards. And actually, we put in the newsletter last week that actually there's even a base level of how far it should move forward for your business to stand still, and that is by inflation plus GDP growth in the country that you're in. So, if those two equal 4% that year, then if you're not moving forward 4%, you're not even standing still. But how can we expand further on that number and what that number should be doing?
So probably most of our listeners would have heard of that famous phrase, turnover is
vanity.
It's yes.
Profit is sanity, cash flow is reality.
Because I use the phrase sales, it really threw me off. So sales is vanity, profit is sanity, cash flow is reality. And so actually there is an element of truth in that actually it comes down to profit and cash flow at the end of the day in your business. You can have these businesses that turn over these huge sales numbers but don't make any profit and can't generate any cash. However, everything starts with sales. If you're a business that cannot get sales in, you don't have a business. There is no business. So actually tracking that sales number from a finance perspective is, the quickest snapshot you can have of a business's general operational health from a day-to-day basis. Is this business able to generate leads, convert leads, and keep customers? Yeah,
I think they kind of look at this also in property terms as well. Just randomly, they talk about this as like the top gross yield or whatever. It's how do you say? It's interesting, but it's not immeasurably helpful. Is how we.
It depends how evolved your business is as well. Because if you think about much bigger businesses, I don't know, take somebody like Costco that are making like 12-15% profit. They know that however much money goes into the till, 12-15% is going to come out the other end.
Yeah.
So when you get your business to that sort of stable point where your numbers are predictable, you know what your gross margin is, you know what your overhead costs are, therefore you know what your profit is. It's very easy for you to say, okay, we want to earn X amount this year, we need to therefore have this much coming in our top line sales number to earn X amount of profit or to generate X amount of cash. So once you understand your financial ratios, you can very quickly apply that to your sales number to set a target for you to take your business to the next step. And that's where sales can be incredibly powerful, because sales is so easy to monitor on a literally real-time basis, whereas monitoring your profit on a real-time basis is much more difficult.
But it's, as we'll learn as we go through the numbers, it's not as straightforward as if I can put another 10,000, another 100,000 through the turnover number, that's going to drop through to the profit and various other things. But what you're saying is that a lot of businesses, when they're very mature, have a very sort of stable percentage drop through, you call it. It can drop through at a rate that you can predict. Is that what you're saying?
Yeah. And actually, even in small businesses, if you know your break-even point, then you know how much is going to drop through for everything you make over your break-even point.
Yeah.
So actually, even for small businesses, knowing your key ratios can be very valuable to helping you monitor if your business is on track on a live day-to-day basis.
Sure. Okay, great. So I think similarly aligned, but slightly interesting.
Yeah.
Take
also,
on it from that
the number one thing on sales is I just think at the end of the day, if you're a business-minded person, you're driven by that number. And there's no shame in that. Yes, you can have businesses that do huge sales and don't make any profit, so it's not everything. But it's very motivating to see that sales number go up. So apart from anything else, track that sales number, because it motivates you, it keeps you going, it keeps you focused on pushing forward.
It's not a financial number, but there's almost a number above that number that I would say, coming from a business owner's perspective and dealing with other business owners, that business owners are even more motivated for, sometimes foolishly. And that may be an arbitrary number like just getting another customer or getting another fine. They get obsessed with my competitor, market share. Market share is probably a good way of describing it. Obsessed with market share. And that may not even drive the right number of turnover from a turnover perspective and be highly detrimental to the business as it drops through those numbers. And that's why focusing only on that number or being hell-bent on that number can be really, really detrimental as well to your business, can't it, as we move through these numbers. So interesting. Turnover. So the next number I've got is gross profit. So first of all, just explain what gross. Some people, Richard Branson didn't know what gross profit was until he was 20 years into business and somebody had to pull it out and tell him. So for just from an accountant's perspective, clearly what's gross profit? How do we determine?
So gross profit is your sales or your turnover less any of your direct costs. And a direct cost is something that you only incur if you make a sale. So if you think on the simplest terms, if you're a business that sells products, it's the cost of buying and delivering those products to your customers. That's your cost of sale, and therefore you take your sales less the cost of your products equals your gross profit.
Okay.
Because if you sold no products, then you would have no costs associated with those products. So that's how you know it's a direct cost or not. Do you have it if you make no sales or not? If you don't have this cost, if you don't make any sales, it's a direct cost. If you have this cost, regardless whether you make sales, it's an overhead or an indirect cost.
Okay. Can you, because I struggle sometimes, I speak to people that struggle slightly with where they categorise something. Can you think of any examples where it might be a grey area, but you can determine where you would put that?
Yeah, labour is a really good one. So if you are, I don't know, let's talk about your business as a classic example. You're a service-based business, and I think a lot of service-based businesses struggle with this. Should they put labour into the gross margin calculation or not? So estate agency, all of your staff are salaried, but they get paid commission. So I would argue that their commission is a direct cost because you only pay their commission if they sell a property. So therefore, if you sell nothing, there's no cost. So therefore, it is a direct cost. So their commission technically should be in your gross profit calculation, but their salary, you pay that regardless.
Okay. What do, across a number of the larger businesses that you work for or work with, where do they put their labour costs usually? In fixed overheads or in gross profit?
It depends. So generally, if you're like a manufacturing business, then you tend to put your labour costs into your gross margin calculation because you have what we would call rolled up costing. You would have a calculation that says this is how much it costs to make this product, and that would include the cost of the materials that goes into it, plus your labour, plus any like setup costs for your machine and things like that. You would calculate that into what we would call the cost of the product. It wouldn't just be the cost of materials. Because
the physical pair of hands producing that product, it's the same. If it was a machine producing that product, you'd put the machine costs, the direct input the machine costs against that product.
Yeah, absolutely.
So you have to put the person against it.
Because if you're thinking about a manufacturing business, there's so many things that go into making that finished product that you sell. And therefore, generally, what you try and do is you calculate what the true cost of that product is, and then you just record that final cost in your system. It's quite complicated accounting when it comes to manufacturing. But for all other businesses, I always recommend that labour goes into your overheads. However, it's then about how you display those numbers and making sure that you understand the impact that they have on the ratio. So often with a lot of businesses that are service-based and where we're putting labour into their overheads because they have staff on salaries, we do a gross profit calculation with and without labour. So we're making sure that we've got that ratio. You're viewing
their accounts in different ways. You're cutting it.
Absolutely, yeah.
So when you actually,
that's
this
really
is
important. When you're just taking your profit and loss out of Xero or whatever system you use, the risk is that there's not even a gross profit percentage on that calculation, but then you're just getting this one static view. And what you really need to do is really look at the numbers from multiple different angles in multiple different ways to make sure that you're painting the full picture.
This is where what you do adds massive value to people like manufacturing, construction, that type of thing, because they may pull it out their system in one generic way, but what you then do is you recut it up in ways that are really useful for them to manage the business and drive the growth of the business forward in a profitable way, rather than accidentally walking into a non-profitable contract or something like that.
Another thing that we also do with some businesses is where, like manufacturing, or I work with a logistics business where we do this, we track the time for employees on the job and then what we call downtime. So downtime would be like training, maintenance, setup, all of that kind of stuff. Okay. And then we will actually split the labour cost every month. So we have their payroll, say their payroll's 50,000. If we say, okay, 40 of that was actually working on the job, we put that into the gross margin. We do an adjustment in the accounts. We put the actual working on the job into the gross margin calculation. And then we know what the true cost of the business of what we would call downtime for the employees is, i.e. unproductive time.
So actually, depending on the sector in the business, you have this sort of rainbow effect from services businesses where you lump lots and lots of labour into fixed overheads, all the way through sort of manufacturing, transportation. And I guess, what about construction? So if you're building a house, it almost feels like the entirety of everything is attributed to the output of that house.
Yeah, I mean, the vast majority of construction businesses will work with subcontractors.
Right.
And therefore they don't have a fixed cost if they don't have a subby working on a job.
Okay.
So from that
So it's
perspective,
definitely a direct-
when you're in construction, generally, if you've got
attribute
subcontractors, it's always in your gross profit calculation.
Wow, I've learned lots just in the gross profit section. This has been brilliant. Let's move on to number 3. It's right, isn't it? Number 3. And we are working down the P&L in...
Sorry, why is it number 3? It's just number 3?
No, but we're talking about the 5 numbers, so it's number 3.
Okay, yeah.
Do you get me? It actually
This
is.
is
Like,
delirious.
this has gone crazy.
Yeah.
Number 3, and we are working down the P&L here in logical fashion.
Yes.
This is, I've called it overheads. Some people call it fixed costs.
Operating costs, another
operating costs.
common
Okay.
term. Yep.
So what is that? We've kind of touched on it a bit. It's kind of
Yeah.
where everything else goes that isn't the gross profit cost, isn't it, that you've just said, I guess?
So your overheads is everything that you have to pay regardless of whether you do any sales or not. So it's going to be your rent, your rates, your insurance, but also any employees that you've got that are on salaries, as we've just discussed. It's everything like that. Also in your overheads is going to be like marketing costs and things like that, because generally your marketing you pay for in the hope that it would generate revenue. There's no direct correlation.
So this is why it's really important so when you're making sales, to split out, to analyze those fixed salaries into the sales to allow you to understand what the profitability of those individual sales are. But irrespective of if you made sales, if you didn't make any sales this month, you've got to pay that salary.
Yeah.
So therefore, from an accounting perspective, it's a fixed overhead. From a useful business analysis perspective, it's good to split it into the sales to understand how your business is performing.
And the best way that I like to look at your overhead costs is, firstly, you want to know what that number is, because there's only 2 things that can happen with gross profit. And I think this is really important when you start to understand.
What are those?
When you start to understand the connection between your overheads and your gross profit, or your overheads and your sales, that's when this can become really helpful. Because once you've made gross profit, the only thing that can happen with it is you pay for your overheads or it becomes profit.
Yeah.
So therefore, if you know that your overheads is, say, 50k a month, and you know that you want to make personally 20k profit a month, that means you've got to make 70k of gross profit. And if you know your gross profit margin is, say, 50%, then you've got to make, what's that, 140k of sales.
Yeah.
So when you start to understand these ratios, it's very easy to then extrapolate them out and set these high level numbers, such as your sales target.
Got you. So this is probably far too big a question for podcasts, but
we'll give it a go.
How do you manage that number, or what should you be doing to manage that number? And I know it's so personal to each business, but is there a percentage to turnover you should be looking at? Is there any red flags if that number's getting out of control? Like, what should you be doing or thinking about to say that number's where it should be, or on track, as you should say?
So I've worked in businesses, like take a distribution business where you're going to be making sort of 20% margin, gross profit margin, and therefore your overheads needs to be much smaller because you don't have as much gross profit to pay for your overheads. But then we look at your business or my business, like a service-based industry, and we're making like 95% gross margins. We've got far more to pay for our overheads.
Yes.
So it really does depend on the industry that you're in. You need to be looking at other similar businesses in your industry. I think the most common way that accountants in particular will tell people to manage their overheads is to set a budget. And I think budgets work in big businesses where they're fairly static and not much is changing throughout the year. But small businesses, particularly if you're a growing business, don't bother with a budget. Coming in on budget just tells you that you spent the amount of money you plan to spend. It doesn't mean that you spent the right amount of money for your business and your circumstances. Okay. Yeah. So generally managing overheads, depending on the value of your overheads, the size of your business, how many things change, I recommend either you do a quarterly, biannual or annual review of your overheads. You make sure that you're not wasting any money anywhere. Yeah. And then outside of that, you're managing them in your management accounts. So when you're reviewing those accounts every month, if we think about overheads, another term for overheads is fixed costs. So therefore you wouldn't expect your overheads to be changing.
Okay.
So you would expect to see a static number every month. And if that number's static, absolutely fine, take no action, as long as you're profitable.
These are costs that effectively, whether they're contracts or outsource or staff, you're effectively reviewing them on an annual basis. You're trying to keep a lid on them. You're negotiating them. You're trying to keep them in line with inflation, not above inflation, and those type of things. Yeah.
And if there are any fluctuations, then your management accountant or your finance director should be explaining to you why your fixed costs have gone up or down every month. Yeah. And, do you need to take any action from that? So you should be monitoring them on a very high level in your monthly management accounts, and then doing an annual, biannual review of them.
Okay, Fantastic. So we're getting to the juicy stuff now. Number 4.
Okay. Yep.
I've called it PBT, as in profit before tax, or people perhaps call it operating profit. Is that right?
So both of those terms are the same. We're getting into this sort of grey area now where you've got lots of numbers that refer to profit. So you've got PBT, which you're correct is profit before tax.
Yep.
Operating profit is generally, people would either interchange operating profit with EBIT, which is earnings before interest and tax. So you can see the slight difference from PBT. And then you've got EBITDA, which would be earnings before interest, tax and depreciation.
And they're all about being able to compare like for like businesses and things like that. So stock market, they use it on PLCs and things like that, don't they? So okie doke. Well, what should it be? What should we be looking for?
Yeah, so your tax number the reason why we have a look at profit before tax, so whether you're using EBIT, EBITDA or PBT, we sort of refer to those generally as one in this conversation. The reason why we always look before tax is because the activities that you take in a year, if we just look at what's happened with the government, we've had a change in corporation tax rate. So therefore, looking at your profits after tax, when tax legislation is completely out of your control, therefore just makes your numbers a bit muddy sometimes if you've got change in tax legislation.
But analysing a business, I understand, you care as a business owner about it. This is about controlling what you can control, isn't it?
Absolutely. And tax is largely for small businesses out of your control. There are a couple of exceptions to that. For example, if you're doing R&D work and you've got large R&D claims in specific financial years, and or if you are making large capital expenditure outlays, so maybe you're upgrading equipment or buying new assets, then that also has quite an impact on your tax bill. So that's one of the reasons why we take tax out of the equation when we're looking at the profitability of the business, because it's largely out of a business owner's control.
Okay, great. And what should the percentage be?
Again, we were talking about this when we were driving. I can't remember why we were talking about this.
It's a trick. Claire, it's a trick question. Do you know why it's a trick question? Because a company like Rightmove make a 70% profit before tax, shockingly high, and
they don't anymore.
Well, they might not, but they're very, very, very high, and everything in between to people that make no profit. So the answer of we had this conversation, didn't we, about what is enough, the word enough. What's enough profit? We were talking about 10%, weren't we? And you said not enough.
We drove past a restaurant, didn't we? And we were talking about
and we were working out what it would be. And
a fairly new restaurant, and it's part of a big chain, and we were talking about how much.
It's just been flooded, so it's closed.
How much profit we think they make and how much is enough. And I think the more important thing to talk about when it comes to your profitability is what, if you were buying and selling businesses, you might have heard this phrase, adjusted EBIT.
Yeah.
Because one of the most common misconceptions with small businesses is that, we're making 40, 50% profit sometimes. Well, you're not, because you don't have any of your salary costs in there as the business owner, and you are involved in that business on a day-to-day basis doing a job. And therefore, I think it's always really important that as a business owner, you keep an eye on what your adjusted profit would be. And your adjusted profit would be, okay, if you added in the true cost of replacing you in your business. So if you've got a experienced, effective MD who can run your business, what would the cost be? Not just their salary, their company car, their pension, annual bonus, all of that. And then you also take out any of the things that you put through the business just because it's your business and you can maybe be a little bit more tax efficient, let's say. And
so many people don't properly take into account their costs. And do you know why they don't do that? Because it's depressing sometimes when they do it. Because they realise very quickly that they end back up at this, at best, 10% number, don't they? They take their business from we're making 5% profit. This is really great. But they have no idea how much they're hanging that business together. And actually the true value of their cost is probably a 6-figure salary.
100%. And in fact, I did some numbers just the other day for a business. They're applying for a loan and they said, Claire, can you just analyse my numbers and, take out what they call business owner benefits? And I kind of need to go and say to them, I haven't had this conversation yet, so hopefully they won't hear it on the podcast for the first time, but I need to go and say to them, look, yes, you're taking a pension out and yes, you're putting your car through the business, but if you replace yourself, the MD would probably have the same value pension and the same value car. So actually, we should be adding in the salary that you would pay that person, and therefore how profitable is your business? Is it as profitable as you think it is? The key aspect to that is that by adding that in and being really clear with that, you're actually then valuing your business on the sales market, aren't you? Truly valuing it, because no investor wants to buy a job. They want to buy an investment. Yes, and this is a really common conversation that I have to have with a lot of business owners is they're like, oh yeah, because somebody will buy my business because I have a good job. And it's like, no, you work 60, 70 hours a week. You
define good job.
You get bumped at the weekends. And if somebody's got a few hundred, if not potentially a few £1,000,000 to buy into your business, why on earth are they going to buy a job?
Well, let's look at this in two other aspects. That if you're not clued up, you said this about the business, about the restaurant, making what's enough, making 10%. And you made a very good point and said, but why would I bother? I can put the money in the bank and make 5% risk-free right now. Yeah. And I would turn that the other way and say, we're big property investors. We can turn our money into a 20% return. Not risk-free, but fairly what I would call semi-passive compared to running a business. So the definition of what's enough, well, it needs to beat those investments for somebody to truly want to invest in it, don't they?
Yeah.
And that's the challenge.
And it's risk, isn't it? Like we were talking about the restaurant and I was saying, well, look, the best you're going to make in a restaurant is 10, 15%, best case scenario. But the chance of you making that, all you've got to do is have a slow weekend and all of a sudden you're throwing away like literally thousands of pounds of food. And therefore all of these things, and, we know the issues with staff and you can't open your restaurant to full capacity because you can't get staff in and all of these things that then are just eating away at the realistic profit that you're going to make means that actually when you adjust for the risk factor, is 10% enough? Probably not.
No.
It's not to me, but it might be different to somebody else. And I think risk is a very personal thing.
Yep, absolutely. So the final number, probably the more depressing number, is PAT, profit after tax, as I've called it. Is it called any other things or how I just always describe it?
Sometimes this might be called net profit.
Okay.
Generally,
that's used.
Yeah, sometimes
I work for business that use net profit
as before tax.
Before tax, yeah.
And some people use it after tax.
Yeah, so it can get mixed up.
Yeah.
What does it mean?
It means the amount of profit that your business has made after you paid all taxes. And the only thing really that you can do with this money is you can keep it in the business or you can pay dividends with it.
Yeah. So keep it in the business to reinvest it or use it, or you can pay dividends out with it.
Yeah. Do most businesses track it? No, not after tax. However, it is something that I always put on like my monthly reporting packs for the business owners that I work with, because I think it's important that if they're not taking a salary out of the business, they understand how much is going to be available for them every year to take as dividends.
It is a difficult one to bother wanting to look at because tax is tax, isn't it? And if you've got a generally good accountant and you know that you're claiming all the allowances you possibly can and you're filing your taxes at the level, and whether it changes from one budget to another, like corporation tax went from 90 to 25, at the end of the day you can't change it. So the only thing you can change is that number being slightly bigger so that you at the end of the day you're keeping the other 75% or whatever it is. So
and I think that's a really important thing is when it comes to changing your profit that you can take as dividends, if you're not happy with it, there's really only two things that you can do. You can cut costs or you can increase sales.
Yeah.
And there's no other way to increase your profit. And actually, if your costs are only about 50% of your turnover, let's say, then a 1% change on that only affects your profit by 0.5%. But if you change your turnover by 1%, that drops straight through to your bottom line.
Yeah.
In most examples. So therefore, if a business isn't profitable, small businesses, I always start with looking at the gross margin and the sales number, because 9 times out of 10, the quickest and biggest win you can get in terms of increasing profitability is to sell more.
It's always the way, yeah.
And you can either sell more goods or you can charge more.
Yeah. And while people wrap themselves up about trying to save a bit of tax or save a bit of cost, and yes, it's important to keep a control on costs of various things, but as you constantly say to people, which is completely different to what I ever hear from normal accountants, is you only care about one thing, which is you want to help them grow their business. Yeah. So you're using numbers to help them grow their business because it's the quickest way to grow your profitability.
Cutting costs is like a one-time event. Okay, so we have a look at your P&L and we cut 10 grand out of your P&L. Now what do we do next time?
Yeah.
So with small businesses, when the overhead base tends to be much smaller, it's not where you start as an accountant.
What was the saying recently? Any fool can cut costs, you said. Was it you?
I don't know.
Clearly looking by the vacant look on your face, it wasn't you. But I think there was a big PLC CEO was talking about any fool can cut costs. And that is true. Anyone can go in and just slash a load of costs out of a business. It's a much more intelligent business owner that can actually generate sales on a structural basis. But,
yeah, absolutely.
Oh my Lord, I love talking about these numbers. That has been fascinating because every time I talk about them, I learn a little bit more, even from you, Claire. Thank you very much. And I've got a really, really, really interesting book recommendation in this week's Profit Cash Growth Extra. So I'll pop this one on here. I read this a while ago. We were on holiday in Dubai, a year or two ago, was it? I read this book. I love it. It's called Predictably Irrational by Dan Ariely. And I tell you why I love this book. And it opened up a world of study that I've done into behavioral economics, and I've just become obsessed with behavioral economics. To be honest, I've become obsessed with human behavior in general, because the more that you can understand human behavior, the more that you can, I don't want to say manipulate it, the more you can work with it, the more you can sell into it, the more that you can influence, persuade, and get people on side. And this book is just unbelievable. It's written from a perspective of scientific research, so doing studies on two different test groups of people where they're treating them differently in each way, and they're just seeing how irrational human beings' decision making is when it comes to economics and business decisions, buying decisions, consumer decisions. And I just love it because it's just fascinating. And what the book actually tells you is that the more you study this, the more that these irrational behaviors become predictable. As in, you can predict the route the decision the irrational decision that somebody is going to make. So therefore, you can understand and put measures in place to do it. And a couple of, there's one good example is just, there's a whole study about how people overvalue things they own simply because they own it. So there's this study where they talk about people having tickets to a big baseball game in America, those that didn't own it versus those that did. I see this massively in the housing market. The different, you ask somebody what their own home is worth, and they'll tell you X. You then ask that person what they think the home they're buying's worth, and they'll say, oh, it's massively overpriced.
Exactly the same with businesses, isn't it?
Exactly
People always
the same with
think their business is worth loads and loads of money, but the buyer doesn't. Completely
irrational. And there's another Profit Cash Growth Extra I'm going to tell you about next week, which is a podcast. But this is a guy that was interviewed on it recently, who's the CEO of AO, Appliances Online. And he told a story which I think is the same sort of thing. And he was talking about how difficult it is to get a consumer to spend just another £50 on a washing machine, for example. Instead of spend £300 on the cheapest washing machine, to spend $350 and get all of the extra benefits and functionality that washing machine will give them. Yet the flip side to that is that they will quite happily put, over its lifetime, hundreds upon hundreds of thousands of pounds worth of clothes through this washing machine, but not spend the extra £50 to make sure it protects their clothes and provides it with a better washing experience and longevity of the clothes. And he had the same conversation about fridges, which I'll go into.
However,
it's interesting.
The risk of having very long 10-minute discussion about home appliances.
Yeah.
Is a washing machine a washing machine? And I would say that if the AO guy, I challenge you on this, and I said,
listen to the AO guy, because I agree, but the answer to this is no.
I agree with you,
according to
but
him, so.
I've never heard anybody in the home appliance arena. Now, bear in mind, I used to work for BSH, which is Bosch Siemens Home Appliances. It's Bosch, Siemens, Neff and Gaggenau. I used to work for a home appliances company, and other than the energy efficiency and the longevity of the machine and things like that, I had absolutely no idea that the machines wash your clothes differently, and or a cheap machine could be damaging my clothes. So I would say that this is absolutely shocking marketing from all the big home appliance companies, because why are they not putting this message out there and educating us? I don't think people are making irrational decisions. I think people are making uneducated decisions.
I'm not even going down that rabbit hole about whether, again, we're going back to human behaviour, about whether humans physically want to listen, physically want to be educated.
Should you research your washing machine before you buy it?
If you put the information in front of somebody 5 times over as clearly as possible, would they still take it in? My experience will tell me often not. So there's not necessarily a straightforward answer to that. But
anyway, check it out. Predictably Irrational.
Predictably Irrational by Dan Ariely. Thanks for joining us for this week's fascinating podcast. A little bit longer than usual, I'm sure, but it is about the 5 key numbers, so really, really important. As always, if you think you might have outgrown your current accountant, please give Claire and the team at Profit Cash Growth a look up. They are absolutely fantastic at helping businesses grow. They've got a big portfolio of businesses across transport, construction, self-storage, you name it now. And these guys are paying dividends. We are physically watching these businesses grow in front of our eyes, aren't we? Because of their, the better management of their numbers.
Yeah,
so
absolutely.
It's genuinely passionate about getting people to manage the business from their numbers, which I just don't think enough business owners do, or they think they do, but I just don't believe they do it well enough. So do check it out, profitcashgrowth.com. Go to the YouTube channel, continue to listen to the podcast, and please, can we just ask you one thing? Please, we do this every week for free. Please, wherever you listen, can you just give us a 5-star review. Just give us some comments. Tell us what you do like about this podcast so we can continue to either do things the way we've been doing it or change it to make it better for you. We really enjoy doing this, and we just want to serve the community that listen to us. We're getting lots of verbal feedback from people. Can I say to the 3 people you've spoken to in the last week who have said how great the podcast is, can you just put it in writing, 5-star?
I thought you were. I've spoken to 3 people in the last week who listened to the podcast, and they will big you up. One person said that you had the best radio voice that they've heard. I possibly know what you mean. So nobody spoke about me, but everyone seems to speak about you, Simon. But we do
people
also
just expect you to be a genius, though, don't they?
We do also have an email address. You can drop us an email at marketing@profitcashgrowth, or drop me a LinkedIn message, WhatsApp, voice note, anything. Any question you want. If you want to whiz a question over to us, we'll answer it live on the podcast, or we'll create a whole podcast about it. We'll see you again next week.